to express our sincere appreciation to you, Carolyn, and to Governor Politz and the Bank of Canada for their focus on transparency and your regional outreach on this critical issue for Saskatchewan and indeed a critical issue for our provincial counterparts around the country. As Carolyn will explain, while bank rate changes are closely tied to inflation targets, the bank has expressed a keen appreciation for the importance that exports have on the economy and the urgency of trade negotiations. In fact, in their news release, the Bank of Canada noted that they will be monitoring closely the course of the NAFTA negotiations and other trade policy developments and their impact on the inflation outlook. So in Saskatchewan, as it is in other provinces, it's not just NAFTA that we need to be mindful of. It's the softwood lumber non-agreement. It's the irrational steel and aluminum tariffs that could be expanded to include uranium exports from Saskatchewan. It's the U.S. tariffs on Chinese goods, most notably on components used by Saskatchewan manufacturers that are re-exported back into the United States. It's our losses due to Indian tariffs on lentils and peas, which is now approaching $1 billion for Saskatchewan. And of course now it's our markets in Saudi Arabia, which are now in jeopardy. But in spite of all this, ladies and gentlemen, Saskatchewan exports year-to-date in 2018 are up by just over 7%. Now, to be sure, that has a lot to do with commodities and commodity prices, most notably oil and potash. But it also has a lot to do with the exchange rate, and most notably the favorable exchange rate that we have with our neighbors to the south of the United States. And that brings us back to the Bank of Canada overnight rate. This is important. It's important to us all. You have heard me say this before, but Saskatchewan's domestic market is small. So we have to export what we produce in order to grow and to succeed economically. Saskatchewan is one of the most export-oriented provinces, one of the most export-oriented countries in the world. Indeed, 1 in 5 jobs in Canada depends on exports, and as many as 1 in 3 in Saskatchewan depends on exports. So in that context, I'm delighted to introduce Carolyn Wilkins. Carolyn Wilkins was appointed as the Bank of Canada's Senior Deputy Governor in 2014 for a 7-year term. She is the first woman to occupy that position in the bank. As Senior Deputy Governor, Ms. Wilkins oversees the strategic planning and economic and financial research of the bank. She also shares responsibility for the conduct of monetary policy with other members of the Governing Council, and she is a member of the bank's Board of Directors. Ms. Wilkins has more than a decade of experience with financial system regulation. As head of the bank's financial markets department, she was in the trenches during the 2007-2009 global financial crisis. Now she brings the Canadian perspective to international authorities representing the bank at the Financial Stability Board, the FSB. She is a member of the FSB's Standing Committee on Assessment of Vulnerabilities and was chair of the FinTech Issues Group, an international committee that studies key supervisory and regulatory issues related to FinTech from a financial stability perspective. Ms. Wilkins is a global leader on financial technology, that's FinTech, and regulation. She's also a member of the high-level advisory group on FinTech on the International Monetary Fund, the only central banker to be asked to join the panel. Don't you just love overachievers? Please help me welcome Carolyn Wilkins.
Well, good afternoon, everybody. It's just great to be here in Regina in what I'd call the waning days of summer. I was out for a run this morning, and it was quite beautiful, a little chilly, but I did notice the trees are starting to change. It's beautiful. I'd like to thank Chris Decker and STEP for the invitation to come here and talk about Canada's economic performance, as well as the announcement that the Bank of Canada made yesterday. Now, the big picture over the summer has been that the global economy is doing well, despite some troubling news on the trade front. Many countries around the world are continuing to grow and put people back to work. And here in Canada, the economy has shown its resilience. I don't know whether you're aware of this, but it's been operating near capacity for the past year. And this is the first time that that has happened since the global financial crisis. Next week actually marks 10 years since Lehman Brothers fails. Time really flies. So this period of sustained growth for Canada seems like it's been a long time coming. Since the crisis, people in Saskatchewan have also been forced to deal with the consequences of the plunge in oil prices. It started in 2014, and lower prices for many other commodities. Now, the Saskatchewan economy, as you know, returned to growth last year, and it's good to see that the expansion is continuing. The Canadian economy is now on solid footing, although we are feeling some headwinds from the trade environment. I know that trade issues are top of mind for many of you here today. You are here as a trade association, and so you know that this environment is difficult. Now, for any businesses facing these kinds of challenges, and the uncertainty that comes with it is pretty crucial to success. Now, farming, just as an example, in Saskatchewan is now an impressively high-tech business. Yet to succeed, business leaders still need to deal with the vagaries of Mother Nature, global commodity prices, trade agreements, but decisions still need to be taken. And it's not that much different for a central banker. I mean, the Bank of Canada's Governing Council has at its disposal some pretty finely honed economic models to guide us. Yet we must take decisions about the policy interest rate amid many unknowns in order to meet our inflation objective. We must also follow through by communicating with Canadians and financial markets about our outlook. And so with that in mind, my remarks today are going to cover 3 points. The first is how the Canadian economy has evolved since our last forecast, which was in July, how we've factored developments on the trade side into our outlook, and then I'll give you some insight into Governing Council's deliberations that led to our decision yesterday to leave our policy rate unchanged. So when it comes to economic developments, Canada has been thrown, what I could say are several curveballs over the last decade. We've had the financial crisis, we've had lower commodity prices, and now we've got trade tensions. And it was only a little over a year ago that we could see that the adjustment to lower oil prices was sufficiently behind us to begin withdrawing the monetary policy stimulus that we'd put in place in 2015. We've raised the policy rate 4 times since July 2017 to 1.5% today. During this period, overall Canadian economic performance has been solid. Growth has been running close to potential, and that's the rate at which the economy can grow on a sustained basis without sparking too much inflation. And I would say that today the policy rate is still relatively low. And by that I mean that it's lower than we'd consider to be kind of a neutral rate of interest. So the data and other information that we've received since July reaffirm Governing Council's view that higher interest rates will be needed to achieve our inflation target. In fact, the global economy is performing largely as we expected. And that's a good thing because it'll support growth here at home. Our neighbor to the south has seen particularly strong demand, both in household and business spending. Now, other countries are showing some signs of weaker momentum, but still growing. I'm thinking here of Europe, China, and the trade measures and uncertainty may be at play here. Meanwhile, most recent data for Canada indicate that growth should average near potential over the next couple of years. Some of you might recall that in our July forecast, we were counting on a quick rebound from the sharp slowdown in GDP growth in the first quarter. And this was a pretty important call, this sharp rebound. And it lent support to our view that July was the right time to raise interest rates by 25 basis points. Now, the GDP data released last week by StatsCan show that we were within spitting distance of our forecast. And that's just a technical expression we use in Peterborough for we were pretty much bang on. The economy grew by 2.9% between April and June, and That's a little over twice the pace that we saw earlier this year. Growth was fueled by consumption and exports, and to a lesser extent, business investment and government spending. So the data support our view that the shift in demand towards exports and investment is continuing. Healthy growth in consumption and home renovations also indicates that households are generally adjusting well to higher interest rates. Now, a wide range of sectors were also contributing to these developments. It wasn't just concentrated in a couple of areas. So, going forward, we expect that the quarterly profile of GDP growth is going to be volatile for the rest of 2018, but still to average about 2%. And what's happening here is that there are some temporary factors that pushed up exports in the second quarter, and they're expected to unwind, and we also had some outages in the oil sector over the summer. Now, those factors will likely weigh on growth in the third quarter, but they don't point to weaker underlying momentum in the Canadian economy. All of this is encouraging, and we're making progress in understanding some of the issues that have been on our minds for a while. Now, the first relates to the housing market and household debt, and how they're responding to a wide range of policy changes. We've had tighter guidelines for mortgage financing that came into effect in January. We've had some provincial measures, just think about BC, that target specific housing markets. And we've had, of course, higher interest rates over the past year. We saw that resale activity in the housing market slowed pretty sharply at the beginning of 2018. Particularly in the Greater Toronto area and the Greater Vancouver area. Now, this swing was actually amplified by the fact that many people had kind of rushed at the end of last year to get their financing and their deals done before the new rules came into effect. And recent data that show that Toronto resales are rebounding and that prices are stabilizing too. In Vancouver, activity and prices remain subdued, although other urban markets that had weakened before, like Regina and Saskatoon, have steadied, and some are showing some recovery. So on a national basis, prices in the housing market appear to be stabilizing. And this suggests that borrowers and lenders are adjusting to the range of policy changes pretty much as we expected they would. And it also suggests that financial vulnerabilities are beginning to ease. They're still high, but they're beginning to ease. So what we're seeing is that household credit growth is slowing, and the household debt-to-income ratio is edging lower. We also see an improvement in the quality of new uninsured mortgages. There's a smaller proportion of households that are becoming highly indebted. And what I mean by that is a number that we follow pretty closely, and that's the share of households that have mortgages and debt higher than 450% of their income. That's pretty indebted. So these are early positive signs, and we'll have an even better view of developments as the data come in. A second issue that we're always working to better understand is developments on the inflation front. That shouldn't surprise you, given that we target inflation. Now, the companies that participated in the Business Outlook survey during the second quarter told us that capacity pressures and labor shortages were intensifying. Yet, wages at that time were rising less quickly than we would expect in an economy that's operating at full potential. Our latest data show that this is actually still the case. We have a preferred measure of wage gains, and it was up by around 2.5% in the second quarter. That said, the data that came out for headline inflation surprised us on the upside. It came in at 3%. Now, we had expected that inflation would average around 2.5% in the third and fourth quarters. We thought it would rise to the upper end of our target range because of temporary factors like higher gasoline prices, rather than because of underlying pressures coming from excess demand. Now, much of the July surprise was due to a jump in the airfare component of the Consumer Price Index, and so we still hold that view. And here's really where our measures of core inflation are particularly important as operational guides, because they strip out a lot of the noise that's in the data, And those measures have remained quite firmly around 2%, which supports our assessment that the inflation increase will be temporary. So let me turn to the final issue, which is the trade environment. Canadian officials have been working hard to resolve the issues, and still a lot of uncertainty remains. Canadian businesses are telling us that trade tensions are among several factors keeping them from investing in new capacity. And that's even though demand and investment intentions are pretty strong in many sectors. We've spoken with firms here in Saskatchewan whose investment plans are in flux, pending more clarity about NAFTA. And other firms here are exploring ideas of whether they should invest to south of the border, or in Canada. And I'd just like to take a second to thank the firms in Saskatchewan who spend so much time every quarter talking with our folks in our Business Outlook survey, because I can tell you our survey that we do across the country has been really instrumental in helping guide our forecast, particularly for business investment. And so these kinds of responses to uncertainty, they're not adequately captured in our models. That's why these surveys are so important. We need to apply judgment. Also, it's good to know in some sense that Canada isn't alone in this. Other countries are experiencing similar outcomes when it comes to uncertainty and the effects of investment. With respect to the actual tariffs that have been announced on steel and aluminum, we incorporated those into our forecast by following two steps. The first step was to look at the potential long-term effects of the recent tariff changes. We used a new model developed by staff that's described in a staff analytical note published this morning. For anybody who's interested in modeling, it's a great read. Now, why this is important is because this kind of model can give us an excellent framework for mapping how trade flows might change and how resources might shift across sectors over the long run. It's very helpful to anchor our thinking, but the long run is pretty far off, and so we have to take a second step that considers what might happen in the shorter term as businesses and workers adjust to the tariffs. That's what we call the adjustment or transition phase. And it sounds pretty friendly, benign, but in fact it's pretty important because it's way too complex for models to capture fully. And the adjustment phase can also be difficult for people. It's also the part of the adjustment that's most relevant for monetary policy. Now, of course, we also assess the implications of the countermeasures implemented by the Canadian government, and when you put it all together, you fold lumber in there as well, the bank estimates that the combination of reduced confidence and trade measures already taken will shave about 2/3 of a percentage points off the level of GDP by the end of 2020. And that's significant. We're seeing some of the effects already, although it's early days. The June trade data showed that steel exports fell the most they have ever fallen since 2008. There was little movement in July. And when it comes to prices, we also expect that Canada's countermeasures will boost inflation by a modest amount, 0.1 percentage points. We haven't seen any of those effects yet, although some producers of beer and pop are saying that they'll raise prices in response to the rising price of aluminum. The outlook for growth and inflation in Canada also is affected by trade and tariff disputes of big players outside our borders, the United States and China. And that's because these kinds of disputes can cause shifts in the prices of many commodities that we produce. It's not going to be news to you, the softening in the prices in products that are important to Saskatchewan, like metals and some other egg prices that happened earlier this summer. Those are the kinds of effects that I'm talking about. At the same time, I want to emphasize that it's important to recognize that it's not all about NAFTA, and it's not all about tariffs. Concerns about weak business investment, firms building new capacity outside our borders, declining market shares, They existed long before the current trade tensions emerged. Competitiveness issues have been hampering Canadian businesses for some time, even while foreign demand has been growing. Canada's overall market share to the US has in fact been declining over the past 15 years, as you know, and this effect has been particularly acute in the manufacturing sector. The trend has meant that there's a much lower share in total employment for most manufacturing industries, with auto parts and clothing, furniture. They're prominent examples, but it's pretty widespread. So regardless of what transpires on the trade policy front, the bank will still need to better understand competitiveness issues to assess the extent to which Canada has permanently lost market share, whether it might get some of it back, and where we are with respect to export capacity. So it's time to turn to Governing Council's policy deliberations that led to yesterday's decision. It won't surprise you to hear that the implications of the current trade environment were front and center. As I just outlined, we've already incorporated into our forecast expected negative effects of uncertainty on business investment and exports, as well as the effects of US tariffs and Canadian countermeasures that have been imposed so far. These estimates are highly uncertain, and they may need to be adjusted as we get more information about the NAFTA negotiations and how businesses are adjusting their plans. Our practice is to not incorporate scenarios that have yet to occur, even though they may be subject of ongoing discussions. That said, in light of ongoing negotiations, the risks to growth related to trade policies are not just on the downside. We tend to focus on those, but there's some significant upside as well. Nonetheless, it's important to understand how monetary policy thinks about this, and that certain trade developments can result in complex trade-offs for monetary policy. On the one hand, protectionist measures can be costly in terms of growth and incomes, particularly as businesses and people adjust. A recent study by the Bank for International Settlements shows that virtually all regions inside of Canada or Mexico or the US, all of them, they could expect to see lower real wages if those countries reverted from NAFTA to WTO tariff rates. Now, on the other hand, protectionist measures can create risks on the upside to inflation, especially when the economy is operating at full capacity. Now, weighing these trade-offs, you can be sure that Governing Council is not going to lose sight of our primary mission. Low and stable inflation will help reduce at least one source of uncertainty for companies and households. Now, of course, there are a number of structural and other policies that are better suited than monetary policy is to help manage what would be complex adjustments. Governing Council also discussed whether the gradual approach that we have been taking to raise interest rates remains appropriate. It's a natural question to ask, given that the economy has been operating at potential for the last year, and it is in this part of the cycle when interest rates typically rise to preempt a buildup of inflation pressures. As I mentioned earlier, the factors that are pushing inflation to the top of our target band appear to be temporary and not signs of excess demand. Now, these factors mean that inflation could turn out to be a little higher over the next couple of quarters than we had expected in July, but will most likely fall off afterwards, barring any new price shocks. Now, we'll need to do a full update of our inflation outlook in our October report, but we already have a good idea of when the effects of the temporary factors at play right now are likely to dissipate. The increases in gasoline prices from earlier this year are contributing 0.7 percentage points to the above target inflation that we see today. And so that means without those, if that hadn't happened, inflation would be around 2.3%. Now, this effect will largely recede by the first quarter of next year. Well, we've seen this in the past, since fluctuations in energy prices have accounted for about 3/4 of the overall movement in inflation over history. And to do our job without causing undue volatility and growth, we need to look through these factors while remaining alert to signs of underlying inflation pressures. Furthermore, we still acknowledge that there may be more room to grow without causing inflation than we've built into our forecast. And we also know that high levels of household debt have made the economy more sensitive to rate increases than it was in the past. And that's just because people must commit more of their income to servicing their debt when borrowing costs rise, leaving less for other spending. Now, the fact that the job market has been particularly strong and the average household incomes are rising, well, this helps the adjustment. Consumer confidence has also been relatively high. And you take all this together, and it suggests that the economy is adjusting well and can adapt to higher interest rates. The bottom line is that we agree, Governing Council agrees, that the gradual approach that we've been following is still appropriate. Now, a final part of our discussion that I'd like to mention was about how much momentum remains in the global expansion. A few would disagree that the US is showing considerable strength. But some commentators see a relatively flat US yield curve as a sign of some trouble ahead. And while there are downside risks to any outlook, Governing Council prefers to look at a broader range of indicators. Well, for one thing, the yield curve is currently not inverted and therefore is not pointing to significant slowing. Besides that, the shape of the curve may not be a reliable signal in the current environment. And this is because longer-dated bond yields are being distorted by a combination of central bank quantitative easing programs, but also strong private demand for long-dated safe assets. Other indicators to look at include credit spreads, which remain narrow. Now, there may be some downside risk to our July outlook for the global economy coming from trade tensions, and some cracks have appeared in certain emerging market economies that have financial vulnerabilities, but with limited spillovers to other countries. It's time for me to conclude. We're encouraged that the Canadian economy is adjusting well to higher borrowing rates and tighter guidelines for mortgage financing. We're also pleased to see the continued shift in the composition of growth towards exports and investment. Recent data are reinforcing Governing Council's assessment that higher interest rates will be warranted to achieve our inflation target. We will continue to take a gradual approach, guided by incoming data. In particular, the bank continues to gauge the economy's reaction to higher interest rates. The bank is also monitoring closely the course of NAFTA negotiations and other trade policy developments and their impact on the inflation outlook. I'd just like to take a minute to repeat what I just said in the conclusion for our French colleagues who may be looking at the webcast. Nous sommes encouragés de voir que l'économie canadienne s'ajuste bien au taux d'emprunt plus élevé et au resserrement des règles en matière de financement hypothécaire. Nous sommes aussi contents de la réorientation compte tenu de la croissance vers les exportations et les investissements des entreprises. Les données récentes renforcent l'évaluation du conseil de direction qui estime que les taux d'intérêt plus élevés seront justifiés pour l'atteinte de la cible de l'inflation. Nous continuerons d'adopter une approche graduelle guidée par les nouvelles données. En particulier, la Banque continue de jauger la réaction de l'économie au taux d'intérêt plus élevé. Elle surveille également de près le déroulement des négociations concernant l'ALENA et l'évolution d'autres politiques commerciales ainsi que leur incidence sur les perspectives d'inflation. Thanks.
Thank you very much, Carolyn, for your insights on the Canadian economy, for your interest in the Saskatchewan economic environment, and the importance of exports to both. It's all very important for all of us to understand the process and the context by which the Bank of Canada sets its fiscal policy and its overnight rates. It's question and answer period time. So we would ask that because we are being live streamed, it's important that you get to a microphone, which are just situated to the back, to my left and to my right. Please state your name, your business, or your agency, and your question, which Carolyn will answer. And while they're gathering, if you don't mind, I'll ask the first question. As you noted in your comments, Saskatchewan has had its share of curveballs on the international stage, and this is after receiving a steady diet of fastballs that we've been hitting out of the park, quite frankly. But it speaks to the uncertainty. Is it a fastball, is it a curveball that really impacts business and business confidence and business investment, as well as our ability to export around the world? But our uncertainties may not be the same uncertainties or the same issues of other provinces. And I guess my question would be, you're a national bank with an interest on the national economy. To what extent do you take regional issues into account as you set your fiscal policy?
You're absolutely right. When we set our monetary policy, we do need to look at what's happening in Canada overall. We look at the macroeconomy, that's what we call the Canadian-wide economy, and what that means for the profile of inflation and take our decisions accordingly. At the same time, that by no means doesn't mean that what's happening in different regions is irrelevant. And you just need to look at the past couple of years to understand why that is. We couldn't possibly have done the job that we did without looking underneath the hood at what was happening in different provinces, because each economy is somewhat different, and when you're hit with different curveballs, the economies are going to react in different ways. And the example of the oil price shock is just a really good one, because overall the Canadian economy did what it did. Okay, it dropped for a bit and then it recovered, but underneath all that, it was almost like the economy was running on two tracks. You had the resource sector that was falling quite a lot. I think business investment was down by 50, 60%. And then when you looked at the rest of the economy, it was growing. And that's really important for us to know, because it affects a lot of things. It means that the interest rates, the changes that we made are helping to facilitate the kinds of shifts in resources and the kind of recovery, changes in prices that will help the economies that are energy dependent get back on their feet. Of course, we can't do that and at the same time forget that our ultimate goal is to target inflation. But to get there, you can't possibly ignore what's going underneath the hood in terms of the Canadian economy. And we learn about that, obviously, from looking at the data, but mostly from talking to people. We cover every region of the country. We talk to hundreds of businesses every quarter, not only through our survey. I've got a great opportunity this afternoon to talk to some business people, and the rest of Governing Council and our staff do that as well. And so it's the nature of monetary policy in a country that it takes a macro view, but that macro view absolutely has to be informed by what's happening on the ground across the country.
Questions, please, right there.
Thank you, Carolyn, for coming to visit Regina and Saskatchewan and for your remarks. My name is Rod Bockwell. I'm from the Ministry of Finance for the province. And I guess my question has to do with your response, or the bank's response to some sort of trade, a permanent trade situation with tariffs. And I thought maybe I heard something in your speech indicating that, I mean, conventional wisdom would be that tariffs come in, the economy slows down, interest rates may fall, or your administered rates may fall, but with prices rising as a result of tariffs, it could cause some other response. I'm just wondering if there's anything you can expand on and what a potential bank response would be to that environment.
That's right. What I was, in the sense of, I was talking about the trade-offs. You know, what would ultimately happen to interest rate would depend on the actual situation and what that meant for the trade-offs. So I can't tell you what we would do without knowing more about a particular circumstance. But this kind of development tariffs that are important in some nature and countermeasures are an interesting thing to look at. It's difficult for people, but it's also imposes trade-offs on monetary policy because clearly it has costs to people in terms of their jobs and their incomes and their economic prospects. There's a lot of adjustments that need to be made, and that means that growth would be lower than it would be otherwise without the tariffs. At the same time, some countermeasures and other effects from just getting in that process of a really efficient supply chain that's been built up over the last how many decades is inflationary. It creates upward pressure on inflation. So you have the downward pressure on inflation coming from slower growth, but you've got also upward pressure as well. And that, we need to see how that balances out. And particularly in the current context, when we're operating at full capacity and we've got core inflation near 2 and total inflation a little bit higher. And so these are the kinds of things that we need to think about. And what's important to keep in our minds and for people to understand is that we would keep our primary mission, which is low, stable, predictable inflation, firmly in mind.
Thank you.
Good afternoon. My name is James Capitosto. I'm with the government of Saskatchewan as well. First, thank you for taking the time to speak with us. I appreciate the chat and conversation. And so my question, it may be a little off topic, and what I'm curious about is the dormant how we might leverage that money for in terms of a report that came out on Friday, which was the Social Innovation and Social Finance Report. And so, for example, the UK used dormant bank accounts to create Big Society Capital, which is a fund that funds social finance and creates a marketplace to solve social problems, human service problems, and also address things like climate change and others. If you could speak to that a little bit, I'd really appreciate it.
Okay, well, I'm very happy to be here. And just to give the audience a little bit of context, so every year there are some balances that become, we call them unclaimed. They've been in dormant accounts that have been dormant long enough that the law tells the banks that they need to sort of hand it over, and we're a custodian of that money. The Bank of Canada is, and that means there's a fairly significant piece of money that people can look up and see whether it happens to be theirs, but only some of it gets claimed every year. So we have a big balance, and only sometimes people come and say, "Hey, I think that's mine," and we give it back to them. And so what other countries have done, including the UK, has said, well, the part that we know is probably not going to be claimed and is just sitting there, could we put it to better use for other projects? That's a very interesting question. The fact that we are custodians of this doesn't mean that we're in charge of actually deciding what can be done with those funds. That's a subject of a government decision and something that would have to be raised with them.
I was going to suggest that they send the check to the Ministry of Finance, Regina, Saskatchewan, across the country. We'd appreciate that if you wouldn't mind. Steve McClellan.
I'll pass that along.
Well, thank you. You'll get back to me on that. Steve McClellan with the Saskatchewan Chamber of Commerce. Considering the time, I enjoyed your presentation, and thanks again for being in Regina. But considering the time of year, and a few hundred meters from us, there are young people who are starting a 4 or 5 year journey in terms of education. They're investing perhaps $100,000 in doing it. You've given us, as the business community, a really good insight of the things to monitor and to keep an eye on, and that you, of course, are very ably keeping an eye on. But what advice would you give a student who today is moved away from home, has this journey ahead of them, and yet watches the news at night and goes, holy mackerel, have I got a future? Should I stop and cocoon for a while? Should I wait till things settle down? What advice would you give that 20-year-old or 18-year-old as they're beginning this next phase of their life, please?
I have a son who's 20 and is in university right now in third year, and so I understand young people asking themselves questions about the future, especially in a world that seems to be changing so quickly. Job markets are changing. We hear all this talk about digitalization, and will we even need people to work? And you know, my view that I've given quite a few times is, of course we will. The question is to do what, and what's the right thing to study, and what's the right approach to do it. And I think the advice I would give, and this is of course personal advice, not official advice from the Bank of Canada, is really to pursue studies. And you know, the best way to succeed is pursue what you love, and keep in mind that what you learn in school is only going to be the starting point for what you're ever going to have to learn, because I think the work environment's already like that, where you can never stop learning. I think it's going to be even more like that, where you're going to have to learn continuously, change skills, maybe even change professions over your career. And so that love of learning, if you've got it, nurture it, and be proactive in discussing with businesses and people that you know what kind of opportunities you might have, what kind of jobs might be out there for you, and how you can prepare yourselves for them. I think that an investment in education, whether it's at university or college, wherever it is a good investment.
We have time for a couple more questions if anybody wants to get to the microphone.
Hi, my name is Doug Matthews. I'm with Saskwater. I thought your comments were very interesting, and thank you very much. I thought your comments about the impact of falling energy prices being largely offset with other growth in the economy was very interesting. In the context of the pipeline world in Canada today, I'm wondering if you would offer some thoughts in terms of where you see investment, employment, and the impacts to the broader economy going, given the pipeline decisions we've seen, and whether or not you think there is strength in other parts of the economy that will sort of mitigate some of those effects.
So pipelines are a pretty important issue for this part of the world, and I can't really comment on any particular deal or any pipeline or development that's happening. We do know, though, that transportation issues with respect to whatever product you're trying to export or move around are pretty important, because they affect the price of what you're trying to sell. And so, just an example, the spread that we see currently between WTI and WCS is reflecting some transportation issues. And of course, what that price is for WCS influences how people view return on investments in that sector, whether there's a business case to expand. And so it is pretty important, and so it's for monetary policy. It's not something that we had put any resolution of a pipeline or finalization of a pipeline is too far off to really be in our forecast horizon. So whether it happens or it doesn't in the short run doesn't make a difference. But transportation, any other kind of infrastructure actually makes a really big difference in the long run with respect to the capacity you have, that potential output we keep talking about, how much you can expect to grow without causing inflation. And so any kind of infrastructure that builds that is something that will raise the trend rate of growth for the province or the country. Where are we seeing growth? It's interesting. We talk a lot about goods and goods exports, and we talk a lot about exports, but domestically, the economy is doing very well. The final domestic demand is quite strong, and there are opportunities within Canada, maybe through more interprovincial trade, to increase potential output. There could be some efficiencies and some synergies from trading this way instead of this way that could help. There's lots of room to go there. We've made some progress, or the government has made some progress, but more room to grow there. I think the other area is services. They've been growing. You look at service exports. They've been growing faster than good exports for the past little while. Certainly, they suffer from some stiff competition from India and China and elsewhere, but that's also an opportunity for Canada. It's not going to make up for losses in other places, but certainly reorienting there. So there's lots of good things going on in Canada, but also lots of challenges. And when we put it all together for monetary policy, at the end of the day, what we see is an economy that's growing pretty close to its potential. And there's opportunities to increase that potential, but it's been pretty steady for the past year.
Any other final questions? Okay. There being none, that concludes the question and answer period and our keynote address featuring Carolyn. And we certainly appreciate your time today. We appreciate your interest in Saskatchewan. And on behalf of STEP and our 400 members from around the province, and through Steve and Amanda, on behalf of businesses around the province that are dedicated to exports and certainly depend on exports, we want to thank you again for your time. You are welcome back here at any time, and hopefully we'll see you back very, very shortly. We have a small token of our appreciation.